Welcome everybody, and we'll get started. So just got a short presentation. I'm going to pack a lot in the next 30 minutes just to give you the simplest possible view on how to line up your charts to find the best possible trade. Now this is starting with the daily Dow. It's just a bar chart because I much prefer bar charts, because I think candles are, to me, trying to trade off candles is not a good idea in the main. There are some exceptions, but I mean, in the early days when I was learning technical trading, there were all sorts of books out there and videos and seminars and webinars on candlesticks. I think this is the days of the algorithms. These markets are dominated by algorithms. So the big question is, how can you work out, how can you predict the next move in the markets and get a step ahead of the algorithms rather than a step behind? Because that's what most retail traders are finding, that they're a step behind the markets. And it's easy to look back at retrospective charts and see, oh yeah, that's what they've done. So this is all about simple strategies, and the best strategies I find that are out there to help you get the most from the market. Okay, and we'll talk about potential next moves in this Dow as we're getting very close to year end now. I think we've got well, it's week 50, isn't it? I think we've got 2 active weeks, and then I think the market will pretty much sort of slow up until early part of January, unless, of course, there is a lot of noise out there. There is a lot of news in that period, but I think in the main we'll get decent volume over the next couple of weeks, and then it will really tail off. So the best thing to do is to, when that happens, is just sit on your hands and don't even look at the charts. Just pack up and wait until you get some decent moves. So, question is, what are the simplest strategies for trading a market like this, and what are the best strategies? Well, what I'm going to talk to you about applies to any market. I've been recently trading oil last week. Had a lot of success out of oil, and I'm not trading much currencies at the moment because I think the currencies are a lot of them are trapped in ranges, and not finding it that profitable to trade forex. So just concentrating on the indices, and stocks. So first off, I'm a massive fan of Mr. Fibonacci. I think Fibonacci is not a complicated tool to use. It's basically just about support and resistance. And because it's I think it's so well respected, I think the algorithms use Fibonacci, and that's why you and I should be using it. So this is a bar chart of the Dow over a 12-month period. And if we do something as simple as, and this, like I said, this works with any range, any market. If you simply put the mark the high and the low with the Fibonacci numbers and levels, you will very quickly see how a lot of that chart just fits. Well, if you're used to seeing Fibonacci values, how it fits. And the whole point of Fibonacci is, let me just grab my pen, is that once you've got a decent move, you can start to measure retracements. So the whole point is, if you've got a decent down move, or perhaps you had a decent up move, what this levels, what this layout of Fibonacci is going to do for you is plot the potential retracements for the next legs down. So if this is the big dominant move, so these levels here are potentially the next areas that you want to short. And potentially, the whole point of Fibonacci is potentially that once this is played out, if you are getting to the stage where you are breaking either back up to the upside or back down to the lows, you've then got measures to find the extensions. So let's see how this year panned out, seeing as this is, I was going to say the high and low of 2018. It's not quite, because we did actually get a couple of moves above this range up here. Otherwise, we've not breached this 23,092 at all. We've only had a minor breach up here just in September and October, which was quickly slammed down. So in the early part of the year, once we had this move up here, we then eventually saw a retracement up to this zone, and then ultimately it was so weak we couldn't quite get to the top of this zone here. So 25,894 would have been a nice, neat technical move up here, but it was so bearish it couldn't quite get up there. But look what happened before that. Before, we actually had a decent push to the upside. Yeah, it was a big, impressive move by the bulls to take that up. But as soon as it got into close to this level here and close to this level here, it was slammed down again. Sorry about that. That's my intercom going off. Yeah, so that's why a lot of retail traders are quite often on the wrong side of the market, because having seen an impressive push to the upside, they're probably still expecting that to get back to the highs. But it's very quickly, the next day it drops close to this zone here, and then a few days later we're back down to support. So part of this is all about just using this measuring device, Fibonacci levels, to plot when to get back in. So if you were not able to, if for whatever reason you were not able to sell that high and get a position there, at least you can get a pullback once the bears have shown how they are stepping into the market, because then we did get a step in about a third of the way up that bar. And that's typically the sort of measure that you get on a retracement within a sell signal like that. And then if you were able to take that, you could day trade it. I'm not suggesting you sort of go on 5-minute charts and start sitting there for hours and then trading this. What I'm going to talk to you about a little bit later on is how you can do this if you haven't got much time on your hands. If perhaps you've got a full-time job and you can only spend, look at the markets a couple of times a day. Well, what I'm going to talk to you about is very well suited to that. Anyway, so you get a big sell signal next day, move a third of the way back into that bar, and then you get 3 days of very heavy selling into that measure there, which is where this originally came from. So we got a big burst up there, a pullback, and another burst up there. So why would I pick that level more than I would pick that level? Well, this level is fine to short. I just think that the top of this particular zone is a much higher probability short for a decent leg down than this zone, simply because you get a lot of, having had a big push to the upside like that, there are still a lot of bulls around, and therefore the best way to sort of trap the bulls is to get them as high as possible. I think it's if you are going to short the market, I think it's our job as traders to get as high as you possibly can if you're going to short the market, and that is the clear move to the downside, and that is an area to watch out for the retracement. If you then look at, let's just talk a little bit about, just a reminder about what these levels are. So this is, so once you get the high and the low, this is the main zone that the Fibonacci numbers give you. This is the inner zone, and this is the 50%, the half measure. Okay, so this is an ideal area to get short. Of course, the reverse is true of a bull move, and so that area there was a good place to short. This area here was a good target. We didn't get down that far on the first effort, what we did on the second effort. So this move here comes back into a sell zone. Don't have to start shorting it because there's the confirmation on the next day where it closes lower. So you trade the pullback into that fib zone, and then eventually it takes a week or two. You can drops back down to that lower zone, overshoots it because it's so bearish, and this of course is the main support here. So it stands to reason that it will come back down to there. Okay, so top zone, drop. Pulls back to the next zone down, drop. Retraces to this zone, drop. So it's stepping down. There's the first main short, there's the second main short, and there's the third main short. In fact, let me scrub that clean. You can see it's getting lower highs all the time. So when I talk about a basic setup, this is a basic sort of stepping down, isn't it? One step, two step, there's a third step there as well, and you get a fourth step there, and all of these are shorting. So what have we seen recently? We've seen the same thing. We came up here in October, shorted down to the halfway mark, came back to the main fib zone, dropped down to an inner fib zone, back into the sell zone. So this is exactly what I was talking about here. So this pattern here is a repeat of this pattern here. Drops down to the 50%, pulls back to this zone, drops down to into support, pulls right up into this 26,000, this top zone, and we find ourselves, that's where we closed on Friday, underneath that zone here. So in theory, this could pull back to this area here, which is 24,500, and we could see 24,000, possibly lower as we come down into this area, and possibly, who knows, maybe even 23,000. So now the other side of this is, of course, if you're using a spread betting account or CFDs, contract for difference, you are using leverage. So of course the big question is, how can you minimize your exposure and get these moves under your belt? Well, I think once you've plotted this chart here, I think then the best thing to do is to drop down to a 4-hour chart. So this is a good chart for people who have got full-time jobs and only get a chance to look at their charts once or twice a day. Let me get rid of this big one up here. So what you can do is, I've marked already the sell signals of this latest move to the downside. So we looked at the daily chart at how those Fibonacci areas were showing resistance levels that we might want to short. So this is a bar chart with 4-hour in a 4-hour period, which is a very good way of trading intra-week. So I would look at something like this either at the end of the day, or if you're able to, midday, between, have a look at it around about the 12 o'clock mark, literally right in the middle of our day, just as the US are getting to their desks. And by 12 o'clock, we are 2.5 hours off the Dow Open. And then, so that is a good time to start to look at it to see where the levels that you might want to take it to. Okay, so if you now apply the support and resistance to this chart here, if you now throw fib levels on that high and that low, so say you're looking to get entries over the last couple of weeks of trading, that's what you would have seen if you had put the fibs on the 3rd of October high to the 29th of October low. So you're basically putting it over the October range. And what you're getting from that is this high up here on Thursday, the 8th of November. Now, there we are looking at that zone again. So this is the high and the low on the red. This is the main outer zone. This is the main inner zone. So on the 8th of November, they took it up right into the perfect area, literally to the pip, up there at 26,300. Where did they drop it? They dropped it right to, literally to the pip, to the low of that range. When they next, having done that, when they did bounce it up to the 50%, it dropped close to the lows. And then we got this nice wind up here, only to close underneath this fib level, come down to this lower fib level, and then go back down to the main support. So let's look at the timing of this. This first signal up here starts at 4 o'clock in the afternoon on the 8th, and by the time you look at, if you looked at your screen at 8 o'clock Friday morning, perhaps you'll get it before you go to work, you will actually see that sell signal I've just identified at 8 o'clock in the morning. And at 12 o'clock that day, let's see, 12 o'clock that day, you would have been here. Get the pen again, I'll mark it here. 12 o'clock that day, this bar opens. So sometime during that 4-hour period, it goes up to 26,125. So you would have needed a stop if you had opened a ticket at 26,125, 135. You'd need to stop at least about 120, 130 pips there. But the risk-reward ratio of that over a 2-3 day period is extremely good. So I'm talking about buying, not the rolling contracts. I'm talking about buying, short selling the next futures contract, the next contract that expires in the coming weeks. Otherwise, if you get the rolling contract, you may still actually lose money because you'll get closed and open again every night you hold that trade. So if for some reason it's showing a loss that day, your broker will close the trade, take that money out of your account where it's showing a loss, and reopen it. That's why it's important. And some of you listening to this might understand that, but just want to make that clear that holding futures contracts, spreading contracts in the next period is, although it's a few pips more, sometimes a good few pips more, it's well worth it if you're planning on holding it. Okay, this sell signal here is, now that will close at 12 o'clock midday on the Monday the 19th. So 12 o'clock that midday, you try and get a pullback into about a third of the way up that bar, which works really, really well at 25,440. And how long would you have to wait? That's the Monday. If you left that until the Friday with a limit buy signal down there at 24,400, you would have made 25,400. You made 1,000 pips in 5 days. So at £1 a point, you'd have made £1,000 if you'd have had about 150 pip stop. Okay, and when last weekend they gapped it up, and on 12 o'clock that day, we'd had that sell signal in the morning. So at 12 o'clock on Monday, that would have given you the chance to short up there at 26,025. And if you'd held that into the Friday, actually, was that the Thursday? That's the Thursday. You would have got, at this support level, you would have got out at 24,250. So you would have got about 1,500 pips, 1,500 pips. There's two trades that are worth, considerable number of pips with very limited risk. And the risk on this trade up here, this one here on the Monday, you need to stop above 26,100. You were risking you'd need about 100 pip stop. So you need to risk £100 over £1 a point to gain 1,500. So the risk-reward ratio, again, is extremely good. And you can find these trades based on the Fibonacci numbers, just by throwing a Fibonacci on your chart. Okay, and if you take that off, you could still trade that on the back of, I did start off by saying candle patterns are, for me, not particularly valid in this day of algorithms, but there are occasions I do like simple lower closes, simple pin bars. In this case, they're fine if they fit, if the criteria of my Fibonacci trading. I'm happy to look at that. Okay, but even here, if you take this example, this is why technical trading is so important. That if you are going to technical trade, you need to stick to your rules. So let's have a look at this trade up here, because that was a sell signal. So you got a nice lower close there, and the pullback was a third into the bar. Now here it actually looks as if that's getting bought. There's quite a lot of green there, isn't it? But if you'd have stuck to your guns and looked at the way in which the Fibonacci numbers were looking from back there, you would have seen that if that's already breached that level there, 285, failed to close above this resistance here at 26,560. So therefore, the chances of that breaking down was still quite high, based on the Fibonacci numbers. So all you had to do is, if you took that sell signal up there, you could start to drop your stop. I think it was fair to drop your stop close to break even by the time you got to Friday. Or of course, you could have just got out of that trade from Wednesday to Friday and then just re-looked at it again next week. obviously it's better just to stay in it and sit it out, because you've got other technical factors that are telling you that is potentially going to come down, because you've got that breakdown of that trend line. Any chart that can't close above a trend line like that is likely to want to come lower. Okay, so what I've talked to you about then, what I've gone through is a situation where, you know, if you've got, once you've got a move and you throw your Fibonacci over that particular chart on a 4-hour, you can take a very limited number of trades. So I pinpointed 1, 2, 3, 4, 5, 6, 7 sell signals over a period of well, this is of a period of a couple of months. There are more there if you want to pick them out. It just shows you, if you want to make a fewer trades as possible with the biggest potential possible, actually, you know, scaling up on higher time frames is a very reasonable way of doing this. You know, I teach people how to scalp, and there are, you know, we've got a simple system for anchor charts and a simpler way of reading smaller time frames, but in many respects it's good to, even if you're scalping, to hold trades like this over, so that you're not having to work hard every day, you know, and beat your screens a lot to capture these bigger moves. So for example, you could take trades like this, because they're, you know, they're few and far between, sit in it and leave it and put it to one side, forget you even got it, apart from, you know, checking your charts once a day. But then you could, you know, enter these charts on, you know, day trading until these targets are hit. Obviously, once the target's hit, stand away, and, you know, then just walk away until you get the next setups. If you can't find a trade, then look in that particular market, then look at a different market. But that's one simple way of, you know, look at these charts and trading them less and less and making more and more money. But if you are a day trader and you've got a good day trading system, obviously mine's the best out there, but if you've got a good day trading system and it's making you money, then keep doing it. But in the meantime, if you want to trade less, particularly if you are limited with the time you've got available to look at these charts, then this is a good way of doing it. This is a good system. By applying basic Fibonacci numbers, you know, the people teach you all sorts of things, like, you know, I'm just drawing some chart patterns here. There's some traders who teach chart patterns. That's a nice funnel drop. There's the old, you know, the old-fashioned ones like head and shoulders. This is a shoulder, head, shoulder. There's the neckline. You can go on, and of course you can talk about candles. But I think, you know, the one that works for me, and the one that I like using the most, is just a simple method of finding a good chart that's had a good clean move and trading the resulting signals that you get from that. Okay, so any questions? I will be, in the next few days, I will be launching an intra-week alert service. So watch out on Facebook for that. And I'll be talking about that. Let's have a look at another chart quickly. Let's look at oil. We could just pull that oil chart out. Tell you what, hang on. duplicate this one and crude oil. So this is crude oil on a 4-hour chart. I've been trading this on the upside only for intra-week moves, not full-scale bounces at the moment. So at the moment, this chart is trying to put in a reversal pattern, but it's not working at the moment. I think in this coming week, could see another test of 50 at least. But I think the next short level that I'm looking for, I think the next short level I would look for is this area here. I think this chart is so weak, it's not going anywhere. So I'm looking for resistance levels up there. All right, okay, that's a good question. Futures contracts. How can I best explain that? Yeah, let me just call something up. Hang on. Right, let me show you this. This is an IG account. And here I've done a search on indices. If I pull up Wall Street, and so on this chart of Wall Street, it happens to be an hourly, I've got two areas up here. One says cash and one says futures. So the cash is the normal rolling contract that you will trade in during the day. And this futures drop-down box is giving you two options. It's giving you there's two sizes of contracts here, $2 and $10, but they complete on December the 18th. So if you trade this contract, you click that and you're into the futures contract now, and you'll see there that so it's labeled up here, December 18, $2 contract, and you'll see the spread, 27 versus 40. So that's a 13 pip spread. So obviously that's a lot more. Obviously the market's not open at the moment. If you look at the cash market, actually because the market's shut, it's showing you a big spread. But actually it may even show you a bigger spread when the market's open. So obviously you can't trade these, or you can trade these contracts at the moment. You're prepared to pay over the odds. But find out how your broker, I don't know who your broker is, but find out where the futures contracts are. And if you're going to trade intra-week and hold it over for 1, 2, 3, whatever days, these are the contracts that I would suggest you want to trade. So when the markets are open, have a look at the spreads. Find out where these contracts are on your account. Have a look at the difference between the cash spreads and the futures spreads. But that's what I'm suggesting you trade. Okay, any other questions? Because I'm going to go and grab some food once we so that's all I want to talk to you about for this particular session, and then I'm going to be running regular free sessions, and like I said, in the coming days I'm just about to launch an intra-week alert service, so I'll talk to you about that. Okay, no other questions then, so thanks very much for joining me. I'll drop everybody a copy of this presentation, and watch out for future free short webinars coming up in the coming days, and this weekly alert service. And of course the trading room is available if you're interested in getting access to the trading room. thank you very much for joining me. And look, if you've got any questions another time, then by all means contact me via Facebook or tradetheeasyway.com. Thanks very much, and enjoy what little is left of your weekend. Okay, bye.